share my desktop here and get started on my presentation. Today's presentation is going to take you through some generalities of why options are interesting, why you may want to pursue those, how you can learn to earn monthly income from trading options, and things of that nature. Now, we're not going to get into anything technical today at all. In fact, over this 3-week class, we're not going to really do a whole lot of technical information anyway, because it's the basics. It's the introduction to give you an idea of what's possible. Beyond that, during any point during the week or at the end of the week, you should have an idea of whether or not you're going to be interested in options, either to enhance your stock portfolio or just to trade, as an amateur part-time or whatever. Of course, myself, I'm a full-time options trader, so I'm a professional, so I do this, pretty much all day, every day. But what I'm going to do is I'm going to boil this down to its most basic simplicity for the next 3 sessions that we're going to have. It's going to be next week. It's going to be Monday, Wednesday, and Friday. So hopefully that will give you enough information to see if you're interested in this type of thing. So let me share my desktop here. And I'm going to go into my PowerPoint presentation. Actually, before I do that, let me stop this for a second, because I need to move my chat panel over to the other screen. I have 2 screens here. I want to be able to see the questions as we go along. Okay, so let's start this from the beginning here. Again. My voice is choppy. Well, let me see. It looks like I'm plugged in okay. Let's do a voice voice test. Sounds like it's an old cell phone. Well, that's not good. Actually, it's a headset. So it doesn't sound very nice, huh? You are breaking up here as well. How do I sound now? Is it any better, or is it still the same? Okay. Well, it may have been because I wasn't sharing my screen. If there's any audio problems, I apologize for that. I hate it when I get online with somebody and I can't hear what they're saying. Or on the cell phone, you hear half of the message. So it's breaking up now again. Okay. I'll have to investigate that. I'm not sure why that would be. So anyway, I apologize. So I'll take it slow enough where if I have to repeat something, I will. Hopefully in the recording afterwards it will be fine. Okay, so this is an introduction to options. We're trading for monthly income. Now, there are ways to do that, believe it or not, to utilize options to trade for monthly income. As I mentioned, this is going to be a basic course. So we're not really going to talk about a lot of technical aspects during the next week, while there's certainly plenty, but we're not going to. So let me see if I can advance my slides. Okay, so this is Option Elements, Introduction to Options. It's a free 1-week class. Who's this class for? Well, it's for those of you who are new to options and want some basic information to determine if it's something that you're going to be interested in, something that you might want to pursue, and just see some ways to enlighten you maybe how you can utilize options to your benefit. Options can be complicated. You can make it as complicated as you want or as simple as you want. So what I'm going to do is I'm going to make it very simple for the next week, so you can see some of the benefits of options and how they work and what it actually can do for you. All right, so here's the class schedule. And of course, this is all free, guys. So, we're going to meet Monday, this coming Monday, Wednesday, and Friday at 4 o'clock. Brian says he's lost sound. Had the same problem with the WebEx this past week, and I had to call back in to solve the problem. Yeah, sometimes you have to do that. If you do lose the sound, you have to log off and come back on and catch up with it. Yes, Sandy's fault. Yeah, probably is actually, because I think that Cisco, who has WebEx, has probably got their servers underwater still. That may be part of our problem. We don't usually have many sound problems. We have WebEx sessions every week with a lot of people, and we don't really usually have any sound issues. It may have something to do with that, maybe. Oh, you mean I have to end the session and call back in? I don't know. I don't know about that. Let's see if. Sorry, Brian. Brian, see if you can log out and log back in. And if that doesn't solve your problem, then with the audio, we'll address it from there. Okay. Okay, so I think that the consensus is we're having some audio problems. Brian says he hears me now. I wonder why that might be. Well, okay. I'll tell you what. I'll continue on with the presentation, and I think that the recording will probably be clear. I apologize. I don't have my IT guy on the line right now to solve any of those issues. But I may have a bad. Oh, okay, Carl is here. Tell you what. Let's stop for a second and let's see. Do I have a bad connection? Do I need to log out and log back in? Carl? Hey, Carl says it sounds okay. All right. Okay, thanks. Sid says now he can hear me okay. All right, well, let's do this. I'm going to go ahead and proceed. Of course, this is recorded, so if for some reason if the audio is so bad you can't stand it, which I hope that's not the case, but if it is, this will be recorded and we're going to email it to you so you can see it. I guess the only thing is you won't be able to ask a question at least today, but I will take your questions. I'm going to show you the email to send them to at the end, and of course Monday and Wednesday and Friday we're going to answer a lot of questions. So. Okay, so let's go ahead and move forward here and say that our class schedule is this Monday, Wednesday, and Friday at 4 o'clock Eastern Time. Okay, that's right when the markets are closing. I do have a live trading room that I operate where I trade all my positions in front of students live and other traders. Some of them are not just students, but traders. And it's going to be right after that. So we're going to do this next week. And probably the sessions are probably going to last about an hour or so, depending on the questions. All right, so what is this class about? Well, it's not going to be technical, not this coming week. This is not a technical class. I'm just going to go over all, a lot of the basics that you're going to want to know about to make an informed decision if this is something that you're interested in doing. All right, so before we get started, I'd be asking myself, hey, Tony, who are you and why the free class? How do I know I can learn from you? Should I spend my time listening to you or not? Well, Let's start with who I am. I mean, I'm a regular guy with a family that I support, and I support them through trading options. I've been trading options for a long time. Lifespan of trading options has probably been at least 15 to 16 years, maybe 17. A lot of that was part-time while I had my previous business. I've been trading full-time since about 2006, so about the last 6 years. I've done okay. I have a track record that's been published through various different channels, so I've done well, pretty consistent. The reason I think that you can learn from me is simply that I do it all the time, and I try to make it simple, and I've got a little history of teaching people that are able to take the information and use it to their advantage. So that's pretty much my background in a nutshell, of course. As I said, full-time professional, trading options consistently over 12 years. I should point out that there was a time when I traded inconsistently because I just treated it as more of a hobby and I was just sort of hacking around. So I went through that stage for a period of years, so I know what that's about. Trying different methods, trying different things, listening to different people. That was early on. But I've straightened that out. I have an options trading room where I operate 3 times a week and trade live in front of people, as I mentioned before. All right, so let's talk about what we're going to do in this class. We're going to talk about what are options and why should someone be interested in them. I mean, that's pretty basic. And, you know, can options be made easy to learn? Is it difficult? A lot of people think that it is. And again, you can make it as complicated as you want, and some people do. But I like to keep it as simple as possible. We're also going to talk about, hey, where do I trade options? I mean, are they like stocks? Where do I get quotes? What are the prices, symbols, this and that? And yes, they are like stocks, but quite a bit different. They have some similarities, I should say. Hey, is this something I can do online from my home or office? Well, that's the interesting thing about technology these days is that, yes, you can trade stocks from your office, your home, your RV, or your campsite, depending on where you're located. And the same thing goes with options. Of course, yeah, you can do it online from your home PC. I mean, that's what I do. I can trade from wherever I'm at with just an internet connection and my software. And I guess last but not least, hey, are there really ways to earn monthly income with options? I mean, is it valid? The answer is yes. And it's been proven, and I can prove it. So there are ways to earn monthly income with options. Now, I'd be remiss if I didn't point out that there is risk in the market, and anytime that you're buying a stock or you're trading options or anything of that matter, there's a risk. You know, just like there's a risk if you go buy a house, you know, the risk is that you may not be able to pay the mortgage or it may not go up in value over time. So there's risk in everything, and there are risk in options, and we'll get to that, you know, during the week. But yes, there's ways to earn monthly income with options. Steady monthly income. All right, so today, for our purposes, options are only 2 things. They consist of calls and puts. Now, the calls and puts are linked to their underlying asset. So we're going to discuss briefly today what is a call, what is a put, and what the heck is an underlying asset. All right, so let's get started. Let's say that the buyer of a stock, he owns it, right? So if you buy Apple, Google, IBM, you own it, and you'll make money or lose money as the stock goes up or down. So you buy it at, hypothetical, $100 a share, and if the share price goes up, you make money. If it goes down, you lose money. I mean, that's pretty obvious, right? But it never expires. The stock never expires, So you can own it as long as you like. Caveat, maybe sometimes a company gets bought out and it's replaced with new stock, but let's just assume that the stock never expires, which technically it doesn't. So you can own it as long as you like. Now that stock can be called the underlying asset. So a stock is the underlying asset when we're talking about options, if you have options on that stock. Other things that could be an underlying asset include stock indexes like the S&P 500 or the NASDAQ 100, or even, strange things like commodities, soybeans, and so forth. So let's talk about options and how they expire. Well, puts and calls expire at predetermined intervals, so that's a little bit different than a stock. So if you were to buy a stock, you can own it forever. We've heard tales of our grandparents, that bought Pacific Railroad in 1912 or whatever and held on to it forever. Well, puts and calls, options, they have a predetermined life. So you can't buy them and own them forever. And that's one of the reasons they're unique. One of the reasons. So keep that in mind as we go forward here today. They have a certain life cycle. I'll just go ahead and jump in and say that normally that life cycle is monthly. So most options have a life cycle that lasts for about a month. Although there's many others that last for 2, 3, 4, 5, 6 months. But we're talking about like the life cycle of options that last about a month from start to finish. Okay, what's a call? Yeah, interesting term too. Look, the buyer of a call, what happens is he has the right, but not the obligation. So he doesn't have to do it. But he has the right to buy the asset. Now, what's the asset? Again, it would be the underlying asset. So let's talk about a stock that people are familiar with. Let's talk about Apple. Okay, so the buyer of a call has the right to buy the asset, i.e., let's say Apple, at a predetermined price anytime before the right to buy it has expired. So in other words, anytime before the call has expired. The call only has a life cycle. So his right to buy it is limited to a certain time span. So that's what the buyer of a call has the right to do, but not the obligation. I mean, if he wants to buy the stock at, say, what's Google? I don't even know what Apple's trading at, but, if XYZ is trading at $100 a share, the buyer of a call, a $100 call, has the right to buy it at $100. But if the stock drops, on earnings down to 80, the buyer of that call, he might not want to buy that stock at 100 anymore. So he has the right, but not the obligation. Now, the seller of a call, he has the right, but not the obligation to sell the asset at a predetermined price anytime before the right to sell it has expired. So if you sell a call to somebody, you have the right to sell it, but you're not obligated to sell it to him, depending on if they exercise it or not. So the buyer has the right to buy, the seller has the right to sell. Now, puts. They're sort of the opposite of calls. The buyer of a put has the right, but not the obligation to sell the asset. So if you buy a put, basically you're thinking that the market's going to go down. Hang on, I got a note here that one of my slides was wrong. Well, that's what happens when you hire a teenager to type stuff in for you. Seller has the obligation, the buyer has the right. That's right. Probably did the same thing on this slide. Well, anyway, let's go through it. The buyer of a put has the right to sell the asset at a predetermined price. So it's the opposite of the call. So if you buy a put, technically what you're expecting is that the market's going to go down. So if the market goes down, what you want to do is you want to sell the asset, and you don't have to own the asset before you sell it. So you want to sell high and buy low. So that's why a put is the opposite, because you can basically buy a put, and if the market goes down, you have the right to sell the asset at a higher price than where the market's at. So you sort of sell it ahead of time, almost like if you're in a say you're in the manufacturing business and you made chairs, and somebody came into your showroom and says, I'd like to buy 6 of these chairs. Well, you may not have them made already, but you determine a price. He buys them, you sell them, then you produce it, then you deliver. So the same thing with a call. If you sell a put, you have, and they got it backwards here. They did. Yeah, if you sell a put, you have the obligation to deliver the stock at the predetermined price if the put buyer exercises it. Now, that's a mouthful to be said right at the beginning of this non-technical description. So we're going to get into the mechanics of that. But this kind of explains, what a put and what a call is. And there's only, for our purposes, that's what we're going to concentrate on, is just puts and calls. We're not going to concentrate on any other variations of these things, which do exist. I'm going to go to a simple way to see this. All right, the buyer of a call usually thinks the asset will go up in price. The seller of a call thinks the asset will go down in price, and of course that's what makes a market, a buyer and a seller. The buyer of a put thinks the asset will go down in price, and the seller of a put thinks the asset will go up in price. Now, here's the good news. You don't have to own a call or a put before you sell it, as I just indicated. A lot of people get confused on that initially. They think, well, how can I sell something that I don't own? You're selling a forward contract, just like if you're going to be in the manufacturing business and you have a set of dining room chairs that someone wants to buy. You may show them a picture or a sample, and they say, I'd like to buy those. You're going to take a down payment. And then you're going to make them and then deliver them. So basically, you sold the chairs before you even owned the chairs, right? Or to make it even more simple, let's say you're buying the chairs from another manufacturer and you're selling it retail. Somebody comes in your showroom and says, I want these chairs. You say, well, here's the price. And they say, I'll buy it. You take a down payment. You pick up the phone. You call your manufacturer and say, ship me a couple of chairs. And they say, well, send us the money for it and we'll ship it. So you've sold something before you owned it. So in stocks and options, we do that all the time. So you don't have to own a call or a put before you sell it. This brings us to another question. Do you have to know whether the market's going up or down in order to make money with options? Because it sounds to me like the previous screen said, hey, the buyer of a call thinks the market's going up. The buyer of a put thinks it's going down. Well, that's technically correct, but you don't have to know whether the market's going up or down to make money with options. That's what this little class is all about, is that we can put a price band around the price of an asset, a stock, or an index, and as long as the market stays within that range for a certain period of time, we can make money on options. So we don't have to pick direction. We can if we want to, but we don't have to. So that's the beauty, and that's another reason that options are unique. Here's another reason, of course, we've mentioned this. Options have a defined life cycle. They also have a certain value that's associated with that life cycle. This value can be called by several names, but for today, we're simply going to call it time value. It can also be called extrinsic value and some other things. But we're just going to call it by, the simple thing, and that's called time value. So the price of an option has built into it a little premium called time value. Whereas if you buy a stock, it has no time value because it never expires. But an option that expires has a certain time value associated with it. And that's where the amateur trader can make monthly income from trading options, okay, because you're going to take advantage of the time value of the options. Because that time value, the amount of money that's associated with the time value, it decreases over time as the option begins to expire or wither on the vine, shall we say. So that's how one of the ways to earn monthly income comes from the time decay of option premium, known as time value. Now, in this little introduction to options course, basically I'm going to show you what time value is and how the professionals earn money from it. And amateurs can do the same thing. With the advent of the internet and all the current technology that's available, it's easy for the amateur to take advantage of what the professional already knows, especially if someone's there to teach it to you. Here's another thing. If you own any stocks, you'll also want to stay with us for the week. And here's why. I'm going to present ways for you to protect your stocks using options. In other words, protect them from, a downslide or a declining market. I'm also going to talk about ways to make income from your stocks when the market's going sideways. Now, usually what that entails, and some of you may have heard of it before, is a little term called covered calls. Now, a covered call is a simple, it sounds maybe complicated, but if you already own a stock, there are ways for you to sell an option against that stock and earn the time decay of the premium that's inside of that option, even if the market just stays right where it's at or even goes down. So we're going to talk about, the pluses and minuses of that in this coming week also. So basically, beginning this coming Monday, the first class is going to be about an hour. We're going to dive right into the actual mechanics of options. We're going to look at actual stocks and stock indexes and their corresponding options. You're going to be able to see what they are, how they relate to the stock. We're also going to go over some of my actual real trades so that I can illustrate, the benefit of options. So it's not going to be some hypothetical, boring sort of thing. We're going to go into the actual mechanics and actual trades that I've made, but I'm going to make them very, very simple for you. Because again, this is the intro to options, so it's going to be a very, very basic class. This class is also going to be fun and interesting, I hope. It's not going to be dull and boring like you see the probability graph here. Yeah, we're going to talk about a few things like that, but it's going to be more like this guy breathing the fire. Although you're not going to have to be it's not going to be a trial by fire. It's just going to be as interesting and fun as I can make it. Yeah, I'm going to show you things like this too. This little matrix over here to the right. It's a matrix of Apple computer options. Now, at first glance, you might be going, wow, what's all those numbers? That's a lot of stuff. But you know what? After 5 minutes of me explaining this thing, this little matrix over here, you'll be able to see exactly what it is. And it's actually really, really simple once I explain it to you. But hey, wait till you can see what we do with that matrix. That's when it gets exciting, okay? For instance, this is a price chart of the NASDAQ 100 index. Now, for those of you who aren't familiar with price charts, if you follow my mouse, I'm going to move it over here to the right, you'll see that every one of these black vertical bars represent 1 day of price action for the NASDAQ 100. So it represents vertically on a graph, where the market opened and closed and what the range was for that day. So 1 day, each one of these bars equals 1 day. Now I've got some lines in here. Those are just trend lines and stuff. Now you see this little red bar on the end, the last bar? That was Friday's price action. Now, I've got a position right now, and would you believe it, that as long as this market here, over the next, say, 7 or 8 days, as long as it stays within this green zone that you see on this price chart, as long as the price action of the market stays within this green zone, I make money. So that's what we're going to talk about. We're going to talk about how we put a price band around the action. We're already making money, by the way, with this position, but we've only got a few days left, as you can see. So as long as we stay in here, we continue to make money more and more. Let me stop here for a second because I've got a question. And the question is, hey, Tony, could you please explain the Greeks, especially when the deltas are positive and gamma is negative? I get tripped over the plus and minus sign interpretations. Okay, I tell you what I'll do. That's a little bit more of an advanced question, and I will answer that. Sid, if you'll give me just a minute, I'll answer that for you. Actually, I think this is my last slide, so I think I might take those questions. Well, basically what Sid is talking about is he's using the language of options when he talks about delta. Okay, delta and gamma, those are two of the factors that indicate the pricing of options, and we haven't gotten into that yet. So, but I will go over that in just a second. Okay, so anyway, as long as the market price stays within the green zone here, that's where we make money. So I mean, just look at this chart, and do you think that's plausible? I mean, do you think it's possible based upon these price bars? Where they've come from, where they're going. This goes back to March of this year, pretty much this price chart. So this line right here, this vertical line is September, down here at the bottom, then October. We're getting into November now. So that's an example of what I'm going to show you guys about earning monthly income trading options. Okay. Now, here's the schedule. Again, the class is going to meet this Monday, Wednesday, and Friday at 4 o'clock. After I present the material, I'll answer, as many questions as you guys have for as long as it takes. All the classes are going to be recorded, so in case you can't attend, the recording will be sent to you. Okay, if you have any questions, comments, want to talk to me personally, whatever, email me at support@optionelements.com. We do respond to every single one of those, by the way. Doesn't just fall off into oblivion. It might take a day or two, okay, but we will respond. Okay, I want to get to Sid's question. So Sid's got a question now. This question is a little bit more advanced. Obviously this is a basic course here, but let me answer his question. All right, I'll just take this example. Please don't be confused over this matrix. Because Sid's question is a little bit more advanced than the basic thing. But basically what he's asking me, he says, hey, Tony, could you please explain the Greeks? Okay, now the Greeks are the measurements that we use to describe the movement and valuation of options. So that's a little bit more advanced than today. But he says, especially when the deltas are positive and gamma is negative, I get tripped over the plus and minuses. Okay, basically down here, Sid, at delta, like right now, this position that I have here in the NASDAQ, is this a NASDAQ? Yeah, the NASDAQ 100. Okay, my delta is long 9.56. Basically, that means that my position is going to gain $9.56 for every 1 point up move in the NASDAQ. My gamma, of course, is minus. Okay, so it's minus 1.33. So that means that as I move up in time, I'm not going to gain 9.16 in delta. My delta is going to begin to get, shall we say, shorter and shorter. So in other words, after the first point move up, you have to deduct gamma from delta. So if you have a negative gamma, what's going to happen is as the market goes up, if you're long delta, you're going to get, it's not going to stay 9. It's going to go to 8, 7, 6, 5. And then eventually you're going to be short delta, like this graph shows. So I don't want to get too far into that today. But I tell you, Sid, actually, if you want to email me that question, I can show you some more examples. I don't want to get way over people's heads here today because I said I wasn't going to get technical on it. So, okay, let's see. Yeah, sorry. Yeah, I'll answer that. Give you more detail on it. Okay, let's see. Does anybody have any like really basic questions like about and I hate to keep this slide up here because well, not this slide, but this is actually the software that I use to determine all my option positions. It looks complicated. It's not complicated, so please don't think that it's going to be this difficult. It's really not. This is just a lot more information than you need right at the moment. So I guess I'll leave it right here. We're into 45 minutes. I don't want to continue to talk about things that are above the level that we're working on, but let's just go back to the fact that what's going to happen is we have the class that's going to start Monday. And if you can't be here live, it'll be recorded. It's going to be basic. I'm going to start out discussing all these things, and I'm going to show you what options are, how you can benefit from them, how easy it is. Talk about brokers, how, if you have an account somewhere with stock already, how you can begin to get involved in this. My goal is that by the end of the week, you'll have an idea of whether or not you're, interested in continuing your education with options to see how they can benefit you or not. Oh, hey, Jerry says, hey, when you sell options, it's like when you sell options, it's like to short an option so you receive cash in your account. Yeah. Yes, exactly. When you buy an option, let's just talk about. You know what? Let's go get as long as I'm on this software, let's go get talk about stocks. Let's talk about Google. It's always fun. Okay. If I were to buy an option, I guess I'll just, since it's question and answer here, I guess I'll go right into it. You see this little button I've highlighted right here, November, and it says 14. This is the November options that expire in 14 days. So Google right now, if you look up here, it's at 687. So let's suppose that I bought this 690 call. Let's suppose I bought one of those, okay? Well, it would cost me $10 to buy a 690 call. The market's at 687. So basically the market would have to be at least above 690 for me to make money, right? Well, no, actually it'd have to be at 697 because it's costing me $10 to buy the call. So basically I wouldn't make any money unless the market got up to 697 within 14 days. Now, if I were to sell that, which is the question that Jerry has, yes, what happened here? Sorry, guys. If I were to sell one of those, it doesn't cost me $10 anymore. I actually get the $10. Now, it's not just $10 because one option to 100 units. So you have to multiply 10 times 100, which you can see down here is $1,000. So basically, if I sold the 690 call one time or one unit, I would make $1,000 into my account. Does that mean that I've just made $1,000 and it's over with? No, because we still have 14 days to see what happens to the price. If the price continues to go up, I could lose money here. And especially if the market went up more than $10, but I would make money if any time between 14 days from now, the market stayed below 690 plus, well, 687 plus the $10 I sold it for, so that'd be 697. So as long as the market doesn't go up more than 10 points within 14 days, I'm going to make money. Now, that's an oversimplification, okay? I'll show you this week how that actually operates in real time and in real data. But yes, that's the way that works, Jerry. So the essence of what we're going to get to this week is that when we talk about earning monthly income from trading options, what generally we refer to is the premium that an option costs for the time value of it. And generally, we're going to be selling those options to collect that time premium over a period of time. But we're also going to be buying options as well to protect ourselves against losses or potential big moves as well. So it's going to consist of both buying and selling options, but I'm going to make it as easy as possible so that you can see the basic rudimentary, fundamental aspects of options and how they trade. Okay, guys. Any more questions for me today? If not, what I want to do is ask you guys to, come visit me Monday at 4 o'clock Eastern time, and we're going to start into, the options and the actual mechanics of these options. I know that obviously, this is a very, very basic course, so I'm going to assume that people that you don't know anything about options, and I'm going to explain all these numbers and strike prices and things like that. So no one will be left behind in terms of the knowledge. And again, my goal is to have the 3 classes and then have you just, say to yourself, well, this is something that I'm interested in, or it's something I'm not interested in. And if you are interested, then we can, determine how to move forward from there. Okay, so I want to thank everybody for being here today. And again, if you want to send this recording to any of your friends, family, whatever, feel free to do so once you get it. I mean, it's yours to have, along with all the rest of the recordings for the coming week. Questions, email me at support@optionelements.com. Be happy to answer those. Again, no question in a basics beginner course, no question at all is unvalid or invalid. All questions are good questions, because if you don't ask a question, if you're unsure about something and you don't get it clarified, that could be a stumbling block for you. So I like to take any and all questions, no matter how routine, mundane, or whatever. Okay, guys. All right. Well, listen, thanks again for joining us today. We're going to pick it up again on Monday at 4 o'clock, and I will see you guys then, and hope you guys have a great weekend.